Good morning, everyone. Welcome to the second online fundamental underwriting course, Strategic Underwriting Techniques. Thank you for joining us this morning. I'd like to take a brief moment before we get started to share some information about NAMIC and my role here. NAMIC works to strengthen and support its members and the property casualty insurance industry by providing effective, high-value advocacy, public policy, public affairs, and member services. As part of the member services team, I serve as your liaison to NAMIC services, develop and manage products and services to help you improve your business operations, work to connect you to the NAMIC community and enhance membership benefits for all, and bring knowledge resources to you. Before we get started today, I'd like to take a moment to thank E2Value for their generous sponsorship of our online fundamental underwriting courses. I encourage you to click through their website to see all of their products and services available to your organization. Today's course will last approximately 75 to 90 minutes this morning. If you have any trouble with your system during our course, please call the NAMIC office at area code 317-875-5250 and ask for Stephanie Giardo. She will be able to assist you this morning with any technical difficulties. We are also recording today's webinar, and recordings will be available beginning tomorrow for your colleagues who are unable to attend the live webinar. Information about all virtual event recordings are available at www.namic.org. Please select the View Web and Audio Event Calendar located at the bottom right of the NAMIC homepage. If you would like to ask a question during today's course, simply submit it through the question feature on the GoToWebinar Control tab. Our presenters will answer as many questions as possible during the presentation as well as at the conclusion of our information. Please submit the questions as they come to you to ensure they are answered in appropriate time. Also during the presentation, our presenters have a few questions for you. We will have several polling questions for you to answer throughout the presentation. Please select your answer or answers when prompted to do so on your screen. So let's get started this morning. This morning we welcome our course instructors, Wendy Hoppensberger, sorry Wendy, and Matt Frazier. Wendy is the personalized product expert for Valen Technology, an advanced data and analytics provider for the property casualty insurance industry. Matt is head of workers' compensation, product strategy, and development for the professional services division at Valen. Wendy and Matt, thank you for joining us this morning.
Thank you, Lauren.
Thank you. Thank you.
Well, good morning, everyone. I wanted to start out by thanking each of you for taking time out of your busy schedules to be on this webinar today. I understand your time is valuable, so Matt and I are looking forward to a very productive webinar today. A little bit about myself and my background. I've been in the insurance industry for a little over 12 years, primarily spending my time in pricing at Allstate, and just recently moving here to Valen. And my primary expertise is in the homeowners industry. Matt, do you want to tell the group a little bit about your background?
Sure. My name is Matt Frazier. I started in workers' compensation at an underwriting desk about 15 years ago, and then held progressive responsibilities on the front end, underwriting, pricing, underwriting management, sales management, and business development. Initially, I started my career at a workers' compensation carrier out of Omaha, Nebraska named First Comp Insurance Company. It was subsequently acquired by Markel. And then after that, spent a little better than half a decade with a company out of New York called AmTrust Financial Services, responsible for developing their workers' compensation business.
Thanks, Matt. Well, let's start by reviewing the agenda. Today, what we'll be talking about in the beginning of the presentation is you, the underwriter, and how recently the focus has significantly shifted to you over the last few years. We'll then talk about some of the challenges you may be encountering to achieve superior underwriting. Next, we'll talk about some underwriting techniques that could lead you towards superior underwriting, as well as include some examples of companies that are using these techniques. And lastly, we'll talk about predictive analytics in a little bit greater detail. So let's get started. So as you're aware, we're currently in an environment of record low interest rates. I just took a look at the interest rates yesterday, and the 30-year Treasury and municipal bonds are running around 3%, the 10-year around 2%, and any maturity less than 10 years is running less than 1%. So how has this environment of record low interest rates affected insurance company profits? Well, historically, insurance companies could and would rely on investment income to make their profit, since premium typically wasn't adequate to pay claims. So in this example, the underwriter is standing next to the premium he's acquired through his business rules, and the investments manager is standing next to the amount of investment income he's earned through corporate bonds, government bonds, etc. So when it's time to pay claims, all of the premium acquired by the underwriter is used, as well as a portion of the investment income. And historically, there was enough investment income left over for insurance companies to make a profit. But in today's environment, things have changed. This is a low interest rate environment, and insurance companies can no longer rely on the investment income to generate a profit. So the investment managers have a more difficult job of generating investment income. So the focus has shifted to you, the underwriter. So as you can see in this example, the underwriter is acquiring the same amount of premium, but the investment manager's pile of cash has declined. So insurance companies are now looking to underwriters to make that underwriting profit without relying on the investment income and the investment managers to do most of the heavy lifting. So I'm going to let Matt now speak a little bit about the status of the workers' comp industry.
So when we take a look at workers' comp, it's a real nice bellwether for the rest of the property casualty industry, partly because workers' compensation has a tendency to be a somewhat problematic line. It's a long tail line. The losses end up catching you significantly later than when you actually underwrite the policies and book the premium. If we just take a look at the workers' compensation line as a whole, a couple of interesting numbers become very apparent pretty quick. The first number is the number 5. Okay. When we talk about the number 5, what that actually is the percent ROE that carriers are getting on their workers' compensation line of business, okay, versus 10% just 5 years ago. Okay, that's a significant difference on your overall return on ROE. Now, there's a couple of different factors to this. Okay, not the least of which is workers' compensation for about the last 5 years has not been performing to profitability. We've had fairly dramatic underwriting cycles in workers' compensation. The last real great cycle that we had was actually back in about 2005. There were a lot of carriers that went into California. California finally decided to fix some of their rates. That cascaded across the country, and we had slightly better overall combined ratios. We actually dipped close to about a 100, 103 combined back then. But the combined ratios have increased up to 115. Now, if we combine the 115 combined ratio with a very low interest rate environment, workers' compensation as a whole is really hurting. So underwriters are struggling to go out there and find better business and to try to create better ways and better strategies of competing in a marketplace with what we call a commodity product. Workers' compensation is a commodity product because you can't really change the coverages very much. You also really can't change anything but the price. Because it's a boilerplate policy, what you see is what you get. Underwriters don't have a lot of tools to be able to throw into the mix on most of the workers' compensation policies. Now, of course, for some of the larger policies, we do have loss-sensitive plans, we do have retros, we do have some large loss deductible plans. But for the most part, if you take a look at about 85% of the policy count out there, they're guaranteed cost policies, which means as an underwriter, you've got to find other levers to pull with your agents and other levers to pull with the insureds in order to make that particular policy that your carrier is selling out there into the marketplace more advantageous to them, more advantageous to your agents than somebody else. Now, we've also got the number 52. And it's interesting because on about 85% of the policies out there, 52%, okay, represents the chance of binding a policy largely regardless of price within 1 hour of response time. So if you get back to an agent within 1 hour, okay, regardless of whether you throw a little debit on that account or whether you throw a credit on that account, on average, you're going to win that business 52% of the time if you get a quote out there within 1 hour, okay? Now, the number 30 represents what happens to that bind a quote or that hit ratio if you extend it all the way out to a 24-hour response time. Now, this study was actually done for policies that were below $10,000. Now, again, $10,000 represents essentially 85% of the total policy terms that are out there, a much smaller percent of the total premium. But what that means in terms of agency experience is that today, underwriters are really starting to get a lot of pressure to turn those quotes around as quickly as possible and provide sort of the least path of resistance, quickest response time. And these numbers really put a point on that. I mean, if your hit ratio goes from 52% all the way down to 30% between 1 hour and 24 hours, just imagine what happens on some of that smaller business if it takes an underwriting department 2 days or 3 days or 4 days to respond. So what these numbers really represent for the workers' compensation line of business is a confluence of different factors that are making it very difficult for underwriters out there and are forcing underwriting teams and workers' compensation carriers to search and seek for new strategies to do it better, to do it faster, and to be able to pull the levers that are necessary in order to write the very best business that they can find out there in the marketplace.
Thanks, Matt.
You bet.
So now we'll talk a little bit about the homeowners industry and some of the similar challenges, actually, to its workers' comp line. These numbers, 105, 69, and 113, do a good job of telling a similar story for homeowners. According to March's 2012 Insurance Market Report, catastrophic events in 2011 made it a record-setting year for insured losses, totaling more than $105 billion, mostly due to the tornado activity throughout the year. And historically, homeowners has proven to be much more volatile when compared to sort of its partner line, auto insurance. According to AM Best and the Insurance Information Institute, homeowners' combined ratio swung from a high of 158% in '92, again, primarily due to Hurricane Andrew, to a low of 89% in 2006, which was one of the best years we've seen in the homeowners market in the last 20 years. But that is a 69% swing in combined ratio. Compare that to the 10% swing in auto insurance, and you have far greater challenges as an underwriter to determine what kind of risk you want to take on in the homeowners market. But volatility aside, the average combined ratio for homeowners carriers in the last 4 years is sitting around 113%, relative to 102% for property and casualty lines, the property and casualty lines of business. So while carriers continue to mitigate against weather losses by diversifying their risk, historical results beg the question of whether current risk management practices are effective and whether carriers have a good understanding of the exposure that they're writing. With catastrophes getting bigger and worse and definitely more frequent, carriers have to ask themselves, are we managing our risk well? So companies are starting to worry about their ability to survive tough years like we experienced in 2011, and CEOs are asking themselves, do we even know really how much risk we have on our books? So it's all of these trends coming together, high combined ratios, low interest rates, high volatility, and increasing catastrophes, They're all coming together at the same time. And Ernst & Young says, therefore, the #1 driver of business performance for insurance carriers is you. It's superior underwriting. So why is it so hard to achieve superior underwriting today? So let's take a look at some of the dynamics in both the homeowners market and the workers' compensation market.
So we'll start with workers' compensation here. Before we advance the slide, I want to give you kind of just a very high-level sense of where workers' compensation was about 15 to 16 years ago relative to where it is now. When I started as a workers' compensation underwriter, every single application that we received either came in through a manila envelope in the mail, it came through the fax machine, as in a Cord 130 app, or some producer out there would scrawl a few lines on a beverage napkin, and then somehow that would find it onto our underwriting desk. We would essentially rate everything by hand. Eventually, we got really technical, and we started to use an Excel spreadsheet in order to rate things. Clearly, that is no longer the case in the workers' compensation market anywhere. Almost everything's being submitted through some sort of an internet or a direct upload from an AMS or an applied system directly from the agent, and a very large portion of these policies are actually getting underwritten, and the prices and the quotes are going out the door through expert systems, through real-time online agency portals, and so on and so forth. So when workers' compensation underwriters and executives think about work comp today, actually getting the type of underwriting quality that they need to drive their combined ratio and their bottom line down has become very difficult because with a fax machine and a beverage napkin, you used to get fewer submissions. And if you can even believe it, it's hard for me to believe, but 15 to 17 years ago, when we were underwriting work comp policies, there was no such thing as Google back at that time. So you couldn't Google something and find 40,000 different pieces of information about a given small business. So you've got underwriters today that are getting more submissions, and at the same time, you'll notice the small box there. They're getting more information. So Kirsten, why don't we go ahead and advance? We're getting a lot more information with regard to every individual policy that we're trying to underwrite. And so what has happened is the human mind can only process a certain number of pieces of information at a given time. What happens is now that we've got almost an infinite number of pieces of information to be able to hang our hats on here, the question becomes, how do we prioritize that information? How do we identify the most important information to take a look at relative to this giant pool of information that as underwriters we now have access to? We can go to Monta, we can go to Google, we can take a look at the Accord 130 app. The Accord 130 app actually has about 126 discrete pieces of information on it. So when we take a look at the 126 pieces of information on the Accord 130 app, we take a look at all the loss runs that we may get. We take a look at everything that we can get on Google or we can get through the internet, and then we also take a look at things like the Work Comp Workstation through NCCI or other data warehouse information that carriers have been able to put together for underwriters. We're now looking at frequencies across about 20 different dimensions, severities across 20 different dimensions, loss ratios by class code, what's the individual history look like for this policy relative to its state, its region, its class code, its premium size. All of this stuff, as you might gather, is extremely difficult for the human mind to synthesize and assimilate. And that presents a real problem for underwriters today. Now, when you add on to that the limited amount of time that underwriters actually have to produce a response or decision back to an agent, we have just talked about the fact that about 85% of those policies are below $10,000, which means that you have a significant advantage if you get that decision and that price quote out to an agent within an hour, which means you've got to assimilate the 126 pieces of information plus this giant data pool that you now have access to within an hour in order to get the best chance of actually doing something about that. What happens if you've got that type of a time constraint is that accuracy goes down significantly. And it's not only the accuracy of the underwriting decision that you can make, but it's the accuracy of the information that you're getting. As underwriters, we all know that sometimes agents or sometimes insureds may hide certain things or accentuate certain things in order to try and get the best price quote possible. A lot of times this results in exposure that may be misallocated across class codes. They like to put a little more of the payroll in standard exception classes like sales or clerical, and a little less, especially in construction, in the roofing class or the plumbing class or the framing class. And so as underwriters, we have a very short amount of time in order to figure out, even if the data that we're receiving on the Accord 130 application is even accurate. And that leads over into problems with regard to the decisions that we can make, because we can't do a great job, given the time constraints, in trying to identify whether that information is accurate in any sort of an optimized way. And so that becomes very difficult for us. Now, there are ways to assimilate some of that information so that it becomes a little bit easier. And one of the strategies that a lot of carriers have actually been using is really to go towards underwriting decisions that are more informed by the synthesis of all of these different data variables that are out there. So instead of an underwriter having to sift through 200 or 300 different pieces of information in order to try and make the best decision possible, what a lot of carriers are doing today is using things like predictive analytics or data warehouses in order to synthesize this information so that underwriters do not have to try and sift through all 500 variables, but can use mathematical modeling and computer modeling in order to identify what may be the top 5, top 8, top 10 pieces of information that are the most valuable things for underwriters to take a look at. And then the underwriter can take those 10 pieces of information and then can create more value by what I call the art of underwriting. And that is to be able to go out there and talk to the agent and add the softer, non-quantifiable information to the underwriting decision. Things like, do they have a safety program? What does the management look like? Have the claims, if there have been any, what's the proximate cause of those claims? And is it something that's likely to actually happen again or not? Okay, so if we synthesize that data using computer modeling, now that the underwriters, instead of assimilating information, really have the ability to optimize those decisions based on 10, 12, 15 quantifiable pieces of information, and then are able to have a very quick conversation with the agent with regard to some of that softer information about safety programs, guards on machines, whether those claims happened as part of a discontinued operation or the proximate cause was something that's not going to happen again, then what we find is accuracy goes up significantly. And as a result, underwriting decisions get better on a portfolio of risk, and that means that the overall loss ratio goes down and the combined ratio gets better. Okay? Now, in addition to that, we also, interestingly, have about 20% of the workforce in workers' compensation and, frankly, in P&C underwriting as a whole. 20% of the workforce is actually going to retire within a few years. So what that means is a lot of that expertise that has been accrued over decades and decades of underwriting different lines of business is actually going to be removed from the environment within the next few years, which means that it's really incumbent upon underwriting managers and younger underwriters to do the very best job that they can in getting that expertise transmitted over to them in the most efficient way possible. So we're going to have a lot more underwriters that are newer underwriters. We're going to have a lot of the older underwriters leaving. The real question is, how are organizations going to maintain that expertise when we've got all of those people leaving and they're taking their expertise with them? There has to be a new way to take all of this disparate information and to be able to synthesize it in a way that underwriters can use it most effectively so that they can make better decisions and as we saw a few slides ago, be able to take a couple stacks of that cash and grab them from underwriting profit instead of just hoping that the investments are going to cover underwriting losses at the end of the day.
All right, thank you, Matt and Wendy. This brings us to our first question for everyone joining us today. Our first question, which option puts the most pressure on your underwriters? And we have 4 choices. We want you to select the option that puts the most pressure on your underwriters, and those choices for you to select will appear shortly, but I'll give you a moment to look over those. Having to process more policies in less time, having access to the most relevant data when making a risk or pricing decision, knowledge transfer from your most experienced underwriters who may be nearing retirement, or none of the above, or maybe it's something different that puts the most pressure on you or your staff of underwriters. So I will open the poll so we can hear what you think, and you'll be able to select one of the choices for this question. Okay, it looks like we've got just a little bit over half that have selected an answer, so we'll give everyone just probably about 15 more seconds to decide what puts the most pressure on your underwriters today. We're almost there. We'll give just about 5 more seconds. Okay, and let's take a look at what puts the most pressure on underwriters. So you should see there on your screen, we have 66% say having to process more policies in less time. Wendy and Matt?
All right, very interesting. We're going to transition now to the homeowners line of business. As we discussed earlier, the homeowners industry is being challenged by high combined ratios and low investment yields. And the homeowners industry has another variable that the other insurance lines don't have to worry about, which is weather, specifically catastrophic weather. So certainly insurance companies can't control the weather and its impact, but if you know certain things about a property, there's potential to possibly avoid losses. Not necessarily in a catastrophic zone, but many times there are losses in the surrounding area of a catastrophe. So as an example, if an insurance company knew a home had a bad roof and they could require it to be replaced or endorse the policy with ACV rather than replacement costs. But the key is, how do you find that bad roof? So the key to achieving superior underwriting in the homeowners line is to know exactly what you insure. So what are the primary problem areas that carriers are concerned about? Okay. So as you can see in this slide, there's a before and after picture. And it says half of all property conditions and liability hazards are being left unfound in the writing at new business by insurance carriers. An example of a property condition could be a bad roof or on the interior, poor electrical wiring. A liability hazard would include such things as, an unfenced pool or a vicious dog on the property. Many times, agents, as Matt mentioned earlier, may not reveal the fact or may never even ask the question about dog type, even though it's a critical piece of information for the underwriter to have. So we know that inspections can be ordered to find things that the underwriter would care about, but inspectors aren't going to find anything if the correct houses aren't the ones being inspected. Hang on just a second. We're having trouble with the slide. Okay. Also, in a recent study done by MSD, they identified that 64% of homes have insurance-to-value deficiencies and that these homes are underinsured on average by 19%. So as you know, ITV deficiencies create problems not only for you, the underwriter, but also for the individual insured at claim time. And this is a major concern since ITV issues have a direct impact on your loss ratio, on premium growth, and ultimately could impact customer retention and satisfaction. So you can imagine the mess after Hurricane Sandy if carriers had ITV problems with a portion of their book of business in the Northeast. Customers who weren't fully insured will be furious if they experienced a total loss to Hurricane Sandy. And so who ultimately pays and makes up for that difference?
Okay. Yep. Thank you, Wendy. And this brings us to our second question as we are talking about ITV and actual replacement costs. Excuse me. We would like to know from you, what is your company's approach to home inspections? We have 5 choices here to choose from. You inspect all new business and no renewals. You inspect all new business and some renewals. Inspect some new business and no renewals. Inspect some new business and some renewals. Or you're not quite sure what your organization's approach to home inspections are. So we will launch our second poll here so we can hear from you. And those choices are available on your screen. All right, we've got just about 85% of everyone that has selected. It looks like we're a little bit more sure of this one than we were of the first one. So we'll give everyone about 10 more seconds for the remaining couple of individuals to answer. And then we will take a look at our results. We've got everyone here that's answered. So Wendy and Matt, here come the results. It looks like we have about 65% inspect all new business and some renewals.
Great. And this is actually what we've been seeing here at Valen when we work with clients is that they're primarily focused on new business. And so to truly know what you insure, realistically, you'd have to inspect every single home every year, but that's really not financially possible. So carriers across the industry have been taking, like I said, varying approaches to trying to solve this problem. And, for the poll, most of you are trying to tackle this problem by putting a gatekeeper at the door, essentially, and identifying everything at new business. So take a look at this common inspection strategy, and that many of you in the audience are doing. In this example, the underwriter is inspecting all new business. He's got his hands full with inspections at new business, and therefore doesn't have a proactive inspection strategy for the renewal business. Over time, the renewal business grows, and it grows, and it grows. And before you know it, the underwriter has quite a large renewal book of business that he's managing. The underwriter knows that the renewal business is aging and that problems are developing, like the ones we mentioned earlier about finding liability concerns, dog concerns, or finding, as the property has aged, problems with the roof or problems on the interior, water heater problems, electrical issues, plumbing problems. But since the renewal book is so large, and as you can imagine, inspection funds are so limited, you have constraints on them, the underwriter may not know where to start. So we actually performed an internal study here at Valen that had extremely interesting results. Suppose you inspected 100 homes at new business and found absolutely nothing wrong with these homes. Now suppose you performed a second inspection on those homes at their first renewal. How many homes would have a property condition or liability hazard that you cared about at the first renewal?
Wendy, thank you for setting that up. We'll give everyone just a second to look at our choices. 3%, 14%, 22%, and 41%. And we will make those options available, so if you'll go ahead and select what you think. We've got just a little bit over half. Any thoughts here? See? Okay, our staff here is going with 22%. We'll give everyone about 5 more seconds to vote. Okay, we'll see if our underwriting staff here was correct. Okay. Wendy, our results should be available. It looks like 46% said 14. 42% thought it was 22% of homes.
Great. Well, the correct answer, according to our study, of course, was C, 22%. You know, if you're a test taker, you know, you always know that C is kind of the right answer a lot of the time, so that may have cued you in. But it's interesting because these homes had been inspected at new business. And at their very first renewal, 1 out of every 5 has some sort of property condition or liability hazard that you care about. So if your focus isn't on both new business and renewals, your renewal business is going to be a problem and is going to be driving your homeowner's loss ratio. You know, many clients that we talk to don't have a proactive renewal strategy. They don't know how to tackle this large book of business and may put business rules into place, but the rules may inspect a property once every 5 years. So if property conditions show up after the first year, you know, what does that home, or what's the statistic after 5 years? And again, we haven't done it at the study to know after 5 years what that is. But if after 1 year it's 22%, you can imagine it's significantly higher. So in order to change these trends, carriers are going to need to focus and potentially do things differently than they have in the past to become more effective, and not only more effective, more efficient in their underwriting activities. So let's talk specifically about strategic underwriting. So I had 3 older brothers growing up, so a lot of the games that I played were games that mostly boys played. One of them was a board game called Risk. Many of you may be familiar with it. The game's subtitle is The Game of Global Domination. So Risk is basically a strategic board game where the player tries to occupy every territory, country on the board, and in the process, eliminate all of his opponents. And to be successful at this game, the player needs to understand his or her macro position at every turn, understand the opponent's macro position, and make a strategic choice accordingly on how to move forward to win the game. And at every turn, you choose your battle, meaning you force your opponent to engage when and where you prefer in a battle that works to your advantage and to their disadvantage. So think about this type of strategic thinking when it comes to developing a strategic underwriting plan. And this is exactly what Dr. Doug O'Bannon writes about and teaches about as a professor of corporate strategy. He uses military examples like this one to help CEOs and corporations think more strategically. And he developed a theory that we're going to talk about today called ADR, which stands for Attack, Defend, and Retreat. ADR is a way of explaining how, when, and why a move or counter move is made in virtually any strategic decision. Choosing the right battles, like I talked about earlier, to fight or to not fight, and where specifically to deploy or not deploy resources is essential to success in the business world and specifically underwriting. So how does this apply to the insurance industry or to you as an underwriter? So all businesses, regardless of size, move and deploy resources every day. Unfortunately, most of the decision makers haven't been trained in how to think strategically about how to move those resources. And strategic decision makers have to decide where to place the important amounts of time, people, and capital. All businesses make these attack, defend, retreat decisions all the time, whether they're aware of it or not. So choosing the right battles to fight or not fight is essential to success in the business world. And it all comes down to understanding the issue of resource movement to the right battle. With an understanding of which battle you may win, resources can be leveraged and companies will ultimately benefit. But without it, companies can waste an enormous amount of time fighting battles that they can't win. It would be like competing against Walmart on price. You're simply going to waste your resources and you're not going to win that battle. So let's first define what attack, defend, retreat means in developing an underwriting strategy, and then I'll give you some examples of companies that are doing a good job of using resources to beat their competitors. So attack. Attack is focused on identifying the segment of business that you want to acquire. Once you identify the segment, you have to develop a strategy to beat your competitors by presenting a better valued product or service to the customer. Better value to the customer could be many things. It could be lower price, better policy coverage, better claims, or better customer service. And then capitalize on that product or service differentiation by identifying and marketing to the business segment that would most desire to have that value. So as an example, Geico makes it really easy to purchase an auto policy online. That's sort of, their differentiator. When they develop their attack strategy, they're primarily focused on the younger generation segment of business who desires to do that business online without ever talking to anyone. So for you, what is the value of your product? And then attack in an aligned manner. Examples of ways to attack would be to work with pricing to implement a new business discount, drop the new business price to acquire the business, and over time raise the price to a profitable level. Or modify your agent commission structure by giving a higher commission at new business, offset by a lower renewal business commission. Those are just a handful of ideas. Defend would be focused on identifying the segment of your renewal book of business that you want to retain. Once you have a new business customer, what can you do to defend against your competitors' attacks? Once you identify the segment that you want to retain, one strategy is to create a customer loyalty program around those customers. Another strategic option would be to create a customer contact program where every customer gets touched in some way throughout the year, whether it's a thank you for your business message, a review of their policy, a birthday greeting, something to retain that business. But some type of strategy to make that customer feel valued in some way and for them to know that you appreciate their business. And retreat would be focusing on identifying the segment of business that may be a problem area for you, more than likely profitability related, and retreating from that segment. In the homeowners market, carriers have identified areas on the coast where they're just not willing to take on that exposure. So what do? They retreat from it. They either stop writing the insurance or they place very high deductibles on that business segment. If you're a carrier open to writing in that area, you have the opportunity to attack and take advantage of another carrier's retreat. So in what areas is your competition retreating, and how can you grow profitably as a result? So based on this explanation, where does your company focus most of its attention?
Thank you, Wendy. We have 4 options for selection where you focus most of your attention currently: on attack strategies, defense strategies, retreat strategies, or you're not quite sure where the focus is at this point in time. So we will launch the poll here. If you'll select the answer that is most relevant to your business today. Oh, we've got about half, a little more than half that have voted. Okay, it's an interesting mix of answers. We've got maybe about 8% left to go ahead and make a selection, so we'll give about 10 more seconds for everyone to make a choice. Okay, it looks like we're all here, so we will share these responses with everyone.
Wow,
looks like we have,
right.
we have about 58% that are currently focused on defense strategies.
Okay. I back in my days in the insurance carrier side of things, I definitely would have thought attack would have been the majority of the answers, but I'm surprised to see defense. How about you, Matt? We may have lost Matt there, or maybe you didn't hear. Okay, well, I'll move on. Definitely surprised by that answer. So. Yeah, I can hear you, Matt.
Sorry about that, Wendy.
That's okay.
I was saying, given the fact that combined ratios, especially in workers' compensation, which I'm most familiar with, have been going up, I think there's an increase in the level of conservatism that carriers are employing right now. So I can actually see there being much more thought around defending the current book of business and trying to maximize the quality of that particular book of business. I think the other thing is that attack strategies can be very difficult to do unless you've got the right tools to be able to do it. And so unless you are a carrier or an underwriting team that has really good tools to be able to grind through the data and try and find, you know, interesting and helpful dimensions in that data to be able to identify where you want to attack, it's so much easier to defend what you believe is already good business instead of sort of forge into the unknown. And so I kind of get the fact that a lot of people have indicated that defense strategies are, you know, one of the critical things that they're spending time thinking about now.
Mm-hmm. Yeah, the key to these strategies is to really identify the segment of business. And that's, I think, one of the greater challenges in the process is which segment do I want to attack and which segment do I want to defend. Of course, I want to defend my entire book, but maybe there's a portion of the book that, you know, you want to defend a little stronger than another portion. So the key is the differentiation and the business segmentation of your book of business as well as your opponent's book of business. So let's go through some examples of companies that are doing either attack, defend, retreat strategies well. Now, most of the examples I'm going to give you are large carriers, but similar strategies can be implemented in small to mid-sized carriers as well. As a matter of fact, the majority of our clients here at Valen are small to mid-sized carriers who are implementing strategic underwriting decisions like the ones we'll talk about. So attack. Let's start here. So both examples here are Progressive examples. The first is that, you know, Progressive lures their prospects to their website by telling them that they can compare rates so that you'll never question if you got the best deal. That's an exact quote, actually, from their website. But once you enter all of your data on the website, they essentially use a predictive model to determine if you're a risk they want and price your risk accordingly. And they're so confident in that price that if a competitor is higher, if a competitor is lower, they're okay with you leaving to go to the competitor because they are so confident that their price is spot on for the risk. The other example is Progressive Snapshot device. This is a small device, if you're not familiar, that fits in your car and tracks your driving habits as you drive. And they say that you can try it out for free for 30 days so that you can get potential savings as a result. They use the data from your driving habits to make a more educated and competitive underwriting and pricing decision that the competitors, since the competitors don't have that data. Drivers with bad habits, they're either sent to the competition or written at a higher rate. Drivers with good habits are written with up to a maximum 30% discount according to their snapshot driving history. So these are great strategies that Progressive is using to try and attack their competition. They're using, data with the snapshots that their competitors don't have. Matt, do you have anything to add to those examples?
I think you did a fantastic job.
Okay, thanks, Matt.
Mm-hmm.
Okay, defend. How about State Farm's Discount Double Check? We've all seen those commercials. This is a service State Farm is offering you as either a State Farm customer or a prospect to ensure that you're receiving all of your discounts. So, out of curiosity, when was the last time you heard from your agent to make sure you're getting all the discounts you deserve? This is a great defense strategy and also a great attack strategy since they open it up to prospects. How about the vanishing deductible at Nationwide? The longer you stay with them, the lower your deductible gets. If you're a Nationwide customer, you'll second guess leaving them, knowing that you'll need a higher deductible at a comparable rate at another provider. So while these examples that we know, while these are examples we know larger carriers are using, no matter what size, anyone can implement a vanishing deductible, or anyone can offer a review of a policy, like these examples here. And the last one is retreat. This one actually comes from personal experience. As I mentioned, I worked at a large carrier, and in 2008, Allstate was retreating from the New York market, specifically Long Island. They were completely reducing their homeowners exposure, and the only way you could have a homeowners policy with them is if you also had the auto. And if you only had the home, you were non-renewed. So they wanted, obviously, in 2008 to reduce their exposure. 4 years later, Hurricane Sandy swept through and caused major destruction in the Long Island area. While Allstate fared well when it came to claims, how do you think the competition did that didn't retreat or that attacked on that retreating business? So regardless of whether you're doing an attack, defend, or retreat strategy, these are some of the tools that underwriters can use today to create successful programs. Here are a handful. You can evaluate your risk using new data variables. Like I mentioned, Progressive is using driving habits. But there's other variables out there that aren't being capitalized on. In the homeowners industry, how can you use weather data better? How can you use demographic data better? And are there variables within those categories that are predictive of whether a risk is good or bad? You can also benchmark your book of business against your competitors to determine, is there adverse selection happening that I'm not aware of? And how do you go about doing that benchmarking? That's an entire different training session, but that's another option. A third category is data quality. How good is the quality of the data that you're receiving on the application, as Matt mentioned earlier? Are there things that are missing or perhaps not filled out with integrity? How do you ensure the accuracy of the application? Is there a way in the homeowners industry to utilize public data to verify that information? And then lastly, sort of the buzz around the industry, in the insurance industry, is implementing predictive analytics in your line of business. That's sort of where Matt's and my expertise lies. So we'll step into sort of a predictive analytics deep dive. I should have asked the poll about how many of you are using predictive analytics today, but I missed out on that opportunity. So we'll step into that, and I'll let Matt talk briefly about predictive analytics here to start.
All right, before I tell you who these guys are, I just want to step back real quick and make one comment on Nationwide's vanishing deductible. One of the techniques in superior underwriting, and of course this is my opinion, really is to dig in to some of the Nationwide national carriers and take a very close look at what they're doing and really ask yourself some critical questions. Why are they doing that, and how can I possibly absorb the strategies that they're employing in my own business? A great example of that might be the vanishing deductible. If you take a look at the vanishing deductible, what Nationwide is really trying to do there is to identify all of the policyholders that have not had a loss, right? This does not work. The vanishing deductible does not work for anyone that's actually had a loss. Now, they probably know within all of their historical data what the future loss ratio potential or profitability is for policyholders that didn't have a loss last year, and policyholders that didn't have a loss for the last 2 years, and for the last 3 years, and for the last 4 years, and for the last 5 years. And so what they're really doing is making a bet based on statistically credible data that is allowing them to identify what the value of a policyholder that's been loss-free for 5 years is relative to the value of a policyholder that had a claim last year, or a policyholder that didn't have a claim last year but had a claim the year before that. And so what they're really doing is banking on the ability to grind through the immense amount of data that they have to identify what the future potential profitability is for policyholders across different numbers of loss-free years, and then apply that as an incentive out there in the marketplace so that people who have been loss-free for 5 years are probably much more likely to stay with Nationwide than somebody that just had a loss last year. And so they're, in effect, proactively selecting the portion of their renewal book that they want to keep by creating a strategy like that. Now, as an old workers' compensation underwriter, if I took a look at work comp, of course, there's not a lot of deductibles on these smaller policies. I certainly could think about doing something like that for some of the deductible policies, but there's not a lot of them out there. But at the end of the day, what I could do is instead move it over to the agent. And if a policyholder has been loss-free for 1 year, they get a 1-point increase in their commission. If they've been loss-free for 2 years, they get a 2-point increase in commission. If they've been loss-free for 3 years, so on and so forth. So there's a way to take something like vanishing deductible, think about it critically, move it over into whatever line of business or businesses or lines of business that you are underwriting, and try and find some sort of a proxy there or an analog where you might be able to use that strategy within your own line of business to maintain and increase the profitability in your own portfolio. I just thought that was a great example. So we're looking at 4 faces on the screen. I don't know if any of you actually know who these guys are, but we're going to start talking about predictive analytics. So what you might gather is that each one of the faces that you're looking at are noted authors that have written about predictive analytics. Okay, Ian Ayers over on the left is a lawyer that actually got interested in predictive analytics and data analysis, and has it's absolutely great book that really touches on being able to use data to outcompete your competitors out there in the marketplace. Now, he came at it from a real interesting place. He came at it as a lawyer trying to predict the way that Supreme Courts were going to make their judgments. And what he learned was that there were lots of experts out there that were making all sorts of predictions about how the Supreme Court might vote or might judge on one or another particular issue. And the fact of the matter was there were only about 29% accurate. But when he took all of those judgments and was able to quantify those judgments based on a number of quantifiable variables that were available publicly out there in the world, he put a data set together and he created a predictive analytic model what he found was that if you included the expert's decision along with all of these other factors and you put it into a model, that 29% success rate in terms of predicting what the future outcome of a judgment would be increased to about 71%. So it was a massive increase in the ability to predict how a panel of completely disparate perspectives in terms of all of the different judges that were on the Supreme Court were going to judge on a particular issue. So significantly increased the ability to effectively make decisions about what was going to happen with regard to those Supreme Court decisions. You take a look over at the next one, Michael Lewis, I think, absolutely great author, wrote a couple of books about the financial crisis, and then got interested in the notion that the Oakland A's were using predictive analytics in baseball. Nobody had even thought about it before, and in fact, it was extremely difficult. If any of you have actually read the book Moneyball, it's extremely difficult for the general manager, Billy Beane, over at the Oakland A's to actually implement this brand new technology within a very old, sort of staid, traditional business practice. You had scouts that were going out and trying to find the very best players, and these scouts had all sorts of notions about what made a good player. The problem was they didn't have any data to support any of their conclusions, any of their decisions. They were always just sort of, you know, hey, look, I think that a particular baseball hitter that spends more weight on his left foot than his right foot is going to be a better ball player. And so they put an offer out to that particular ball player and not to another ball player. What they didn't do was really sift through the numbers. And there's a tremendous amount of data that's available in baseball. Obviously, it's a very statistically oriented sport, but none of the ball clubs were actually using any of this data in order to try and make better decisions. So what happened as Billy Beane started to implement predictive analytics within a staid industry, baseball, very traditional, was that the Oakland A's, by virtue of the fact that they were making better decisions and drafting players based on those statistical relationships that they were able to find within the data that they had available to them, was that the Oakland A's, in 1 year, went from worst in the league to best in the league. And they absolutely annihilated everybody else. Now, since then, there is not a baseball club out there today that does not use predictive analytics to try and optimize their ability to pick players in the draft. So it really has transformed that industry into something completely different that is almost centered around predictive analytics at the outset, and some of the traditional scouting second. The next one's Thomas Davenport. He wrote a book called Competing on the Analytics. This is an absolutely phenomenal book if you just want to get a basic understanding of how predictive analytics is transforming different industries, and how predictive analytics works, and how you can take data and you can actually outcompete any of the competitors out there that are not embracing this new technology. And then finally, we just had national election a little while ago. This is a relatively new book by an individual named Nate Silver. Now, the interesting thing about Nate Silver is that he was in an environment, right, politics, where there was absolutely nothing but pundits and experts, and everybody had an opinion about everything. The interesting thing about that is that Nate Silver used predictive analytics and ground through the data, and he was actually able to correctly predict 49 out of 50 general elections for the Senate race, for the presidential election, and he absolutely annihilated all of the pundits and all of the experts. He far surpassed them in terms of predictive ability. That's another great read. There's a couple of other authors that I'll mention if you're interested. There's a gentleman by the name of Nassim Taleb who wrote a book called The Black Swan, and he also wrote a book called Fooled by Randomness. Both of those books, absolutely great books about decision making and about how being able to use modeling or computer modeling in order to identify relationships between data really can give you a specific advantage over anybody that's out there that's not actually using these types of new technologies in order to synthesize data and in order to optimize the decision making that you can do. Now, why are we talking about all these guys? We're talking about all these guys because at the end of the day, one of the biggest strategies that carriers are employing right now in order to make better decisions and in order to outcompete other carriers in the marketplace is predictive analytics. Because as we all know, insurance are treasure troves of huge amounts of data. There has been a giant wave recently in carriers just trying to codify that data and trying to develop new data structures so that they can capture more data in some quantifiable way, and then they can actually run computer models against that data to help underwriters with tools that allow them to make better decisions, spend less time on data that doesn't matter, more time on data that does, and synthesize some of that data so that they can use that, and instead of having to look at 500 pieces of data, they can look at one piece of data that synthesizes 300 pieces of data and go out into the marketplace able to make more educated decisions much more quickly and much more consistently, thereby being able to outcompete some of the other underwriters out there in the marketplace.
Okay. Great. Thanks, Matt.
You bet.
So I'm going to quickly touch on this example of how Target used predictive analytics. Andrew Pohl was the Target statistician charged with growing the baby market specifically at Target. And so he looked at historical buying data with the goal of increasing that market share. You know, probably similar to how maybe you're charged with either growing or possibly retaining customers at an insurance company. So he looked at the historical buying data for ladies who had signed up for Target baby registries and found some really interesting patterns in their buying patterns. He found that they were buying larger quantities of unscented lotion around the beginning of their second trimester. He noted that pregnant women load up on supplements in their first 20 weeks of being pregnant. And he noticed that when a client buys a combination, specifically, of scent-free soap, an extra big bag of cotton balls, hand sanitizer, and washcloths, it signals they may be pregnant. That's something that, you know, you and I would not just be able to figure out standing at the front door of Target, looking at people's carts and trying to figure out, are they in their first trimester or not. So using all of this data, he was able to identify 25 different buying patterns that signaled if a woman was pregnant or not. Now, what did he do with that data? They then developed a marketing strategy around it. They started sending coupon books timed at specific stages of the target customer's pregnancy. They called it actually a pregnancy score, and it was assigned to every customer's ID. At Target, each customer, probably you and I, if we've ever used a credit card there, has a guest ID number. So they ran those guest IDs through his predictive model, and each guest ID was assigned a predicted pregnancy score, or the likelihood that a guest may or may not be pregnant. So they started sending these coupons out for baby items to customers, and they were very targeted coupon books for cribs, diapers, all of that stuff. And the interesting part of the story is that an angry man then entered Target outside of Minneapolis and was very upset, told the manager that his 16-year-old daughter got a baby coupon book in the mail, and was absolutely infuriated, couldn't believe that Target would be marketing baby products to his 16-year-old daughter. So the manager took a look at the coupon book. Sure enough, the name was addressed to his daughter, and couldn't apologize enough to this man. Felt terrible about it for days. And days later, the manager decided to pick up the phone and call this angry man to once again apologize for the error. And on that call, the father, somewhat embarrassed, apologized to the Target manager because, in fact, his daughter confessed to being pregnant. Now, that's a pretty wild and amazing story of the power of predictive analytics. But thinking about that, what if you could use your insurance data, like Andrew Pohl mastered Target's data, to predict something that mattered to you, and something that aligned with your attack, defend, retain strategy. There are models available that predict which customers in your book of business are, for example, most likely to leave you, and customers that are most likely to stay. Those are called retention models. If you were to engage with either a third-party vendor or to develop a predictive modeling department within your own insurance company, this may be something that you would see. It's called a lift curve. And I'm going to speak through it from Target's perspective. So Target scored all of their customers, all of their guest IDs, and assigned, as I said, a predicted pregnancy score. And from there, they segmented their customers from, we call it bin 10, or the most likely a client would be pregnant, down to bin 1, which is the least likely they would be pregnant. And that way, they didn't have to spend an incredibly large amount of money doing the marketing. If they wanted to just send coupon books out to bin 10, which I have a hunch that that's probably what they did, they could maximize the return on their investment. This is something that's called a lift curve, and you would see this if you engaged with predictive modelers. On the left-hand side, it shows the number of customers. Those are target customers, just in this example, and they would be equally distributed by bin. Then each bin would have the average predicted score associated with it. So as you can see in bin 10, these are obviously very made-up numbers, but in bin 10, there would be, in that group, a 60% chance that that guest, that target customer, or target guest as they call it, is pregnant, as opposed to in bin 1, there's a 0% chance that that guest would be pregnant. I would think that that bin would consist of all men. And then they would compare that against their actual data, what they truly and actually know about that person. Is that person pregnant or not? And they would compare those two lines to see if their predictive model is a good fit. So if you were, like I said, ever to engage with a predictive modeler as a third party, or if you were to build a department internally, these would be the things that you would see coming from them. So we're going to go over oh, go ahead, Matt.
No, go ahead, Wendy.
I was just going to say we're going to go over a couple of case studies that talk a little bit about predictive analytics, and specifically to the lines of insurance we've been talking about today.
So we'll start with workers' compensation. We just talked about those 10 different bins that Target would have put the customers in. Bin 10 obviously had the highest percent chance of individuals being pregnant, and that's who they would send out a coupon book to. When we translate it over to insurance, and what we're going to be talking about in this work comp case study, the way that you want to think about it is policies that fell into bin 1 had a loss ratio that was significantly better than a carrier's book average loss ratio. And policies in bin 10 would be those policies that you would not want to write. They had a loss ratio that was significantly higher than the overall book average loss ratio. Okay? Now, for this particular case study, it was a regional work comp carrier that was writing in, it's actually a mutual carrier that was writing in about a 4 or 5 state region. And the carrier came to us and wanted to see if predictive analytics would create a competitive advantage as they chose new markets for growth. Now, this carrier was using very traditional methods of underwriting. They had a fairly constrained appetite, certain class codes that they really liked to write. And they were doing pretty well. They had 9,500 policies in force, about $189 million in premium, and they were writing that at an 87% loss ratio. Now, that 87% loss ratio was a pure premium loss ratio, so without the loss cost multiplier, without any of the expenses loaded in. And so, in theory, they were doing about 13% better than average, given the fact that NCCI tries to balance their rate plans out at about 100% loss ratio. So they're doing 13% better than average. So they engaged with us, and we performed a little research project for them. And the way that we did that was, give me one second here, was we created a scenario using these 9,500 historical terms that they had previously written. And we basically split up two theoretical underwriting groups. So we took underwriters and we put them in one group, and we called them the traditional underwriters. Okay, that would be a set of underwriters that would price exactly in accordance to the way that this carrier priced historically, with the same schedule of credits and debits, the same pricing deviations that the underwriters had available to them at the underwriter's desk when they were underwriting these risks and deciding which ones were good and which ones were bad. Okay, and then we armed the other group of underwriters with a few predictive analytics scores. Okay, so we actually built a model. The model would predict how good the risk was, whether the risk was significantly better than average or worse than average. It would predict whether there was misclassification on the policy, so whether it was classified correctly or whether there was a high likelihood that exposure might move from one class to another if you were to go out there and do a physical audit. And then we also built another model that predicted if exposure were to move from one class to another, whether that exposure moving to the other class would increase the premium or create additional premium, or decrease the premium or create return premium. Okay. What we found was pretty staggering. So what happened with the traditional underwriting, that's the top one, is they ended up writing 5,600 policies out of the total 9,500. Okay, they still ended up with $110 million in premium, but the big difference was they now ended up with $109 million in losses at a 99% loss ratio as opposed to the 87% loss ratio. So you can see that they were in some way adversely selected against because they ended up with policies that they thought were pretty good policies, but they weren't. And so they ended up booking those policies, whereas the group of underwriters that had predictive analytics was able to stay away from those policies because the models told them that those were going to contribute to an increase in overall loss ratio. If you take a look at the view that was powered with predictive analytics, they ended up with $69 million in premium. So they ended up writing less of the premium. It's interesting to note that a lot of that has to do with the fact that when we look at a given carrier's book of business, we find that underwriters in general, underwriting groups, are much more aggressive with larger premiums than they are with smaller premiums. Now, that kind of makes sense, right? We all want to try and get the larger premiums in the door, but it's interesting to note that they put more credits on those larger premiums without regard to risk quality. And so there's a little bit of error or bias that goes into an underwriting decision associated with those larger premiums. Just in general, underwriters, I think, like to write the larger policies than the smaller policies. They end up getting more aggressive with those, and the risk quality suffers. So the group 2 with predictive analytics ended up with $69 million premium, only $54 million in loss, and they ended up with a 79% loss ratio. Now remember, that's as opposed to the original 9,500 policies that had an 87% loss ratio. So you had a significant increase here by virtue of underwriters being able to use predictive analytic tools to help support some of those underwriting decisions and pricing decisions. And what the net difference was, if you take a look at the 99% loss ratio for the traditional group versus the 79% loss ratio for the group using predictive analytics, there's a 20 loss ratio point gulf between traditional underwriting and underwriting using the new technologies that are available today. That's a huge difference in terms of overall profitability.
Okay. I will quickly go over a homeowners case study that we here at Valen performed using predictive analytics. We partnered with an insurance carrier that knew they had policies on their book that had they had more information, they either wouldn't write that piece of business, or they would require some kind of modification to it, either a replacement cost adjustment or require some sort of home repair by the insured. But like all home carriers, identifying those policies at new and renewal business that have those problems, such as a bad roof, is a challenge. So this carrier tried to solve the problem using traditional business rules. That's what the majority of insurance carriers are doing today, and used variables like age of home, square footage, and coverage A. Those were the three dominant variables that were driving their business rules to find the type of policies that would require that underwriting action for the least amount of cost. Using those traditional business rules, this carrier found an issue to address 40% of the time. In the industry, underwriters call that the action rate. 4 out of every 10 homes, they found something to remediate. So while actually pretty effective, they realized, hey, I'm wasting money on 60% of the policies that we send inspectors out to. So they thought, how can we use predictive analytics to improve that waste of money or improve my action rate? So we partnered with them and used additional variables beyond age of home, square footage, and coverage A. We looked at storm patterns, climate patterns, census data, all sorts of things, demographic data, and developed a predictive model for them. And we discovered that their action rate using the predictive model increased to 68%. So they could now find issues, almost 7 out of every 10 policies they inspected, a 70% increase. And they found, they calculated their return on investment being 6 to 1 using the predictive model. They were able to then optimize their inspection spend by obviously then increasing their action rate. So those are just a handful of examples, some success stories in the insurance industry, as well as the non-insurance industry, like the Target example we gave you, of how predictive analytics can lead you down paths to help you fulfill your attack, your defend, or retreat strategies. So I'm going to turn this over to Lauren, and if there are any questions out there, then we would love to field them.
Wendy and Matt, thank you very much. As Wendy just mentioned, if you have any questions, please go ahead and submit those through your questions feature on your GoToWebinar control tab. I know Matt and Wendy covered lots of information today with a lot of great examples. So if you have any questions or would like some clarification on any of the information, please go ahead and submit that at this time. I'm sure if you have a question that many of your colleagues have a similar question as well. So we'll give everyone just a minute or two to start submitting those questions, and then if we have questions, we'll go through those. If not, we'll move forward. So we'll give everyone just a minute or two to submit any questions. Well, Wendy and Matt, you guys must have done an excellent job. I don't see any questions coming through at this point in time, but if you have any questions as you are going through your tasks or going back and looking through the information, please feel free to send those to webinars@namic.org, and if there are questions that need to be forwarded on, we'll be more than happy to forward them on to Wendy and Matt. So with that, I would like to thank everyone for attending today. And Wendy and Matt, thank you for taking some time to share your expertise with us this morning. You will be receiving an evaluation to the email address on your registration. I encourage all of our attendees to take a couple of minutes to complete the evaluation as we work to continually enhance our virtual events offerings here at NAMIC. Our next online fundamental underwriting course on underwriting communication is scheduled for Thursday, April 18th at 10 a.m. Eastern Time. We do still have multi-course discounts available, so if there are 5 or more courses that you had your eye on, please go ahead and register for those. Registration information is available on namic.org on the Web and Audio Events calendar page, which is located, the link is at the bottom right of the NAMIC homepage. Thank you again for your participation in our course this morning, and we look forward to having you again. I hope everyone has a wonderful afternoon. Thank you.